Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Welcome back to all of our repeat listeners, and thanks for checking us out if you are new to the podcast. With the name Healthy, Wealthy, and Wise Retirement Podcast, I like to cover a wide range of topics, some relating to health, and of course the majority of episodes relating to wealth and your retirement planning. But by adding the "and wise" at the end, well, that gives me free rein to dive into about any topic. This week's episode will be a bit of an overlap of all of these, as I thought it would be helpful to talk through some of the questions I'm most commonly asked. I'm sure this will become part one of many that we will do over the years, as I always jot down questions that clients ask. When I notice that I keep writing down the same questions, I figure other retirees may have these as well. So hopefully you find at least some of these questions and answers helpful. First, what makes your firm different from others? I love being asked this question, and it's a good one to start off with because it's really the whole reason behind why we started Integrity Wealth Management. Years ago, I turned the microscope on my own industry of financial planning, and I really did not like a lot of what I found. Instead of focusing what's wrong with the industry, I'll try to balance that out with our solutions. There are three key differences that really jump out to me. The first is that the majority of financial firms still offer what's referred to as investment-only advice. Their offer to the public sounds something like this: put your money with us and we will get you a better return. There's certainly nothing wrong with that, but to stop there at just investment management, we're missing major opportunities to integrate financial planning, tax planning, and much more into the picture. The term comprehensive planning has become somewhat of a buzzword in the industry. Some firms do a great job of following through with this, while others use it as more of a marketing piece. We get specific about what comprehensive planning means at our firm by plugging each of our clients into what we call our retirement readiness process. This includes anything from investment management, Social Security, Medicare, and insurance planning to tax, estate planning, goal setting, and much more. So the first key difference involves offering comprehensive planning versus just investment management. The second difference that jumps out to me is that the overwhelming majority of firms still operate in a sales capacity rather than as a fiduciary. To me, this is just where the industry needs to get better and make major changes. I won't harp on this for long, as I've already covered this topic in detail on past episodes, but if you're not familiar, being a fiduciary simply means that the advisor is not only morally and ethically obligated to act in your best interests, but they are legally required to as well. The financial industry even allows advisors to advertise themselves as a fiduciary even when the advisor is a part-time fiduciary, meaning they act in your best interest sometimes, then moments later can act as a salesperson. The challenging part for you as the consumer is that you don't know which role the advisor is playing in that moment. This is why we believe it's necessary to act as a fiduciary at all times, which is how we're designed as a firm. So thus far, we have comprehensive planning, always acting as a fiduciary, and third, we have our flat fee pricing structure. While comprehensive planning and being a fiduciary amount to only a small percentage of financial firms, having a flat fee pricing structure would only show up as a sliver if you're looking at a pie chart for compensation models. Within the past few years, we are starting to see a few more flat fee firms like ours, but we are still the overwhelming minority, swimming upstream in an industry oversaturated with firms who charge based on the size of your portfolio. If you'd like to dive deeper into this topic, check out my past episode titled Let's Get Clear About Fees. As far as what makes our firm unique, those are the three that jump off the page to me. In addition, we also focus solely on planning for retirees or those over the age of roughly 60. And last, this may fall under the category of comprehensive planning, but my big picture vision is, for those who want this to be part of their planning, to integrate health and wellness as well as biblical values into our services. I've talked about this a bit in the past, but to me, all of the investment and financial planning in the world won't mean much if we don't have our health. Additionally, if faith plays a big role in who you are, it seems silly to place this off to the side rather than making it part of the discussion. Let's move on to our second question. We don't want to put all of our eggs in one basket. Does it make sense to divide our money up between a few different advisors? People hear about the importance of diversification, which is absolutely true, and it's necessary for a solid investment plan. But where I see this concept mistakenly applied is that it is sometimes viewed as diversification of advisors rather than diversification of investments. Let's just use a quick story to illustrate this. Husband and wife Jim and Deb typically spend $200 on groceries. This is enough to purchase every item they want. No more, no less. But this time, instead of coordinating their shopping, they split the $200 and each go to the store with $100 to buy what they need. Without communication, what do you think this would look like? In all likelihood, Jim will pick out some things that Deb did not, and Deb will buy some things that Jim didn't think to grab. But there's also going to be some overlap. They come home with 2 bags of potatoes, but no banana or bread. 2 gallons of milk, but no cereal. They each got a bag of coffee grounds, but neither got the coffee filters. You can see where I'm going with this. Bringing it back to investments, when one hand doesn't know what the other is doing, you not only fail to achieve the extra diversification you were seeking, but you've weakened your diversification and have created inefficiencies in your plan. It may be possible for 2 advisors to work together, but I would contend you are always going to have a few leaks in communication, not to mention you would be paying multiple advisors instead of just one. A better alternative would be to have another advisor review your plan and give you their independent feedback. Sure, if you do this, you might get a little bit of a sales pitch from the advisor who does not currently have your business, but if you seek out your second opinion review from a fiduciary who already has a successful practice and doesn't really seek to work with everyone they meet with, then you should be getting great feedback even if you have to pay a one-time fee for the advice. Our third question. My investments are going down. Should we bail out? Everything is going up. Is now a good time to get out? I hear some version of this on both ends of the spectrum. The reality is that buy and sell decisions should be made based on our investment policy statement. If you're like most and you are not familiar with what an investment policy statement is, this is just a formal way of saying that these are the rules we are following with regard to your investments. A simple example would be your portfolio construction. Let's say you like the balance of 60% stocks and 40% bonds or alternatives. If stocks do well and that portion of your portfolio grows to 70%, we do not rebalance back to 60-40 based on when it feels like the right time. Instead, we have a rule in place that if our portfolio drifts 10% or more, that's what triggers a rebalance back to your original allocation. This puts our emotions properly where they should be with regard to investment decisions, on the sidelines. Further speaking on this for a moment, a phrase I often use is that the market is never doing something. It's only done something. Just when there might be 24 different indicators pointing toward a market decline or a pullback, there might be 32 indicators that we're unaware of that cause the market to go up. Trying to use techniques like market timing, trend analysis, and other strategies for buying and selling at just the right time are losing strategies that cost people a fortune along with their sanity. A more healthy way to look at investing is to picture yourself walking up a flight of stairs with a yo-yo in hand. The yo-yo goes up and down just like the stock market does in the short term. But over time, at least for the past 100+ years, the stock market continues to go up just like the flight of stairs. It's not always the smoothest walk up the stairs, and of course past performance is no guarantee of future performance, but the stock market is still the best way to grow wealth that we know of to date. Jumping to our fourth question, how can your fees be so much less than other advisors? I laugh a bit when I say that because I don't want this to sound like a sales pitch, but I'm truly passionate about this so I apologize if it comes off salesy at all. I do all of my own content, all the way from the writing and recording for this podcast, and it's tough to always find the right words to use, so I always appreciate a little grace and latitude from anyone listening. When looking at our flat fee, retirees are naturally inclined to compare this with other advisors, or in many cases, their current advisor. But many advisors work for firms that are decades and decades old. There's nothing wrong with an older firm. In fact, it's a testament to any firm that has stood the test of time. However, these older firms often have outdated methods for pricing their services, expensive real estate in which their office is located, and layers and layers of mouths that need to be fed. They often have research departments that are no longer relevant in today's age, massive marketing budgets, and could be paying for the pension and benefits of a past president no longer even working there. I've seen the inner workings of some of these companies and even been a part of a couple in my younger years. The term lean and mean is about the furthest thing that comes to mind when looking at these firms from the inside out. So maybe the real question shouldn't be why we are so much less, but why others are so much more. At any rate, I'll give you a few reasons that initially come to mind. First, we've done everything we can to have that lean and mean look. If we were a 30 or 40-year-old firm, we would have to tear down a lot of pieces to rebuild it more efficiently. It was much easier, however, to simply build it efficiently in the first place, as the vision for Integrity Wealth Management first started back in 2015. We strategically paid quite a bit more upfront so that we did not have to partner with a broker-dealer or another registered investment advisory firm. This meant for more cost right out of the gate, but only a fraction of the cost when we look at the big picture. By doing this, we were able to eliminate layers of red tape and expenses that simply did not add value for our clients. A second way in which we are able to keep our fees lower than most of our competition comes to technology. We try to be a forward-thinking firm, so while we are always looking at what is best in class as of today, we're also thinking about what the industry will look like in 10 and 20 years. We're not always going to be right, but it's still a powerful way to think, and it allows us to be nimble and change as needed to benefit our clients. We have an amazing relationship with a handful of technology companies in the financial services space and can often receive deep discounts simply for our feedback to their development team. I joke about this, but the best camera most of us will ever own sits in the palm of our hand. It's our cell phone. Yet, many financial firms still feel like they're trying to make the Kodak camera work. In the same way that an iPhone can deliver a better picture at a fraction of the cost, technology helps us deliver better financial plans without layers of expensive overhead. I'll touch on two more quick, as I'm sure there are others, but these would be the top four that come to mind. So a third way we keep our fees down is that we don't really do any marketing. Our business grows almost exclusively from introductions from our clients or from people reaching out after listening to the podcast. We will occasionally meet retirees through our educational seminars or appreciation events, although these tend to be for clients of the firm already, so we don't really think of these as marketing. And fourth, this one may not be a popular opinion, but we simply don't take on non-profitable clients. I would venture to guess that most firms undercharge 90% of their clients and subsidize that time and money lost by overcharging the 10% of their clients who have more substantial assets. Most of the people we chat with are not going to be a good fit for our services, and that's perfectly okay. In fact, I still welcome the conversation and enjoy speaking with retirees regardless of their situation. I never want to lose sight of where I was when I first started in this industry back in 2006. So even though I know that most of the people I meet are not going to become clients, we always try to leave people better than when they came to us. We do this by offering a complimentary retirement risks analysis and giving them actionable steps to take if there are areas to improve. I think it's really important to stay humble and never forget the people who helped you get where you are now. With that said, I think it's equally important to charge a fair rate to everyone without making a small percentage carry the load for others. Before moving on to our next question, I want to make sure it's clear that I don't think we are the only firm out there that is lean and competitively priced. Some firms manage billions of dollars and simply a razor-thin profit margin makes everything work. Other firms are much smaller and look pretty similar to ours. They share a lot of these same characteristics and, quite frankly, are some of the advisors who I introduce people to when we are not a good fit. Let's move on to our fifth question. Why are your fees so high? Funny enough, I get asked why our fees are so high almost just as often as why they're so low. Of course, everything is a matter of perspective. If we peer out over the Grand Canyon, we probably feel pretty small ourselves. But to an ant, the bottom of a shoe looks enormous. So before jumping into what our fee is, we typically first take stock of where you're at now, as a fee audit is part of the 14 risks covered by our retirement risks analysis. Often, this will uncover that retirees are already paying more than what our fee is. It's just that we are very transparent about our fee, so there's never any hiding behind it or finding out later that it's not really what you thought. With all of that said, our fee is on the higher end for those with less than roughly $600,000 of investable assets. This just comes down to the way we built our firm. We wanted to be experts in our lane rather than trying to be a good fit for everyone. Using a medical analogy, it would be a little like going to your cardiologist for a knee replacement. But of course you wouldn't do that. You want your cardiologist to stick with heart surgery and your orthopedic surgeon to stick with what they do best. We believe financial advisors should do the same and become experts in their area rather than simply being serviceable to everyone. We have 2 more to go, so let's cover our 6th commonly asked question. Is being a fiduciary really that important? Others have told me it's more of a formality. I was a bit surprised when I first was asked this question, but since then I've been asked different variations of it several times. I guess it's no surprise that someone who is not a fiduciary is going to tell you that it's not all that important. All I can say is that you better buckle up, because if this is where the conversation starts, you're about to be in for a sales pitch. When it comes to finances, we live by the motto, trust but verify. Without the fiduciary aspect, there is no verify, and you're working on blind trust. Worse yet, if things go sideways, the advisor can always claim that it was your responsibility to look into things, and they are not legally held responsible. If they are not a fiduciary, this is 100% true, and it's your responsibility to do your due diligence and determine if your advisor's advice is in your best interest. So the short answer here, yes, it's really that important. Finishing up with our 7th question. Can I introduce my neighbor or relatives to you if they don't have a lot of money? First off, the phrase a lot of money means different things to different people. I think what's most important is to help people do the best with what they have, whether you would call it a lot, a little, or anywhere in between. Secondly, I know I've mentioned this a few times, but for everyone who is introduced to our firm, we've made the decision to offer a complimentary retirement risk analysis with no strings attached. This helps accomplish a few things. First, it helps us determine if they are a good fit for our firm, meaning, does their situation and the issues they may have align with our expertise and what we do well? In short, we're not trying to be all things to all people, so it needs to be a good fit for the skills we have. Of course, the reverse of this could also be the case, and we might not be the firm they are looking for. It's easier to find this out when we complete that retirement risk analysis as they get to know us and our process. To me, this is a much better outcome than starting a relationship and figuring out years later that it wasn't a good fit. And finally, if we are not a good fit, as is often the case, we have a handful of firms we could introduce them to in order to find a better solution. We don't have any relationship with these firms or financial gain by doing this, but we've done the vetting process for them so that at a minimum, they will be working with a fiduciary who is qualified with a CFP designation, meaning they are a certified financial planner. Closing up this last question, it may sound like I put this one in just as a plug to get introductions, but we really do get asked this fairly often. In conversations with clients, they've sometimes been hesitant to introduce someone as they are unsure if they would be a, quote, good client or not. But my advice is always to take this burden off of their shoulders and let the person they are introducing decide for themselves. We really do appreciate introductions, as this is how our firm grows without advertising and marketing, which, as I mentioned before, allows us to keep our fees lower for everyone. As I pointed out at the beginning of this episode, I'm sure I will record a commonly asked questions segment from time to time, particularly as you continue to send in and ask about more topics. In fact, there were already a handful of questions that I didn't cover in this episode regarding estate planning, cryptocurrency, tax questions, and many more. I'm guessing that for a few of these, I will want to do a deep dive, so some will likely become their own standalone episodes exclusively on that topic. Nevertheless, keep sending in your ideas via email, and I will get to as many as I can. That will do it for today. You can find past episodes at healthywealthywiseretirement.com, and I will talk with you again in 2 weeks.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.